for silver. NASDAQ, exactly the same, 2 weeks in a row for the NASDAQ. S&P 500, exactly the same, 2 weeks in a row for that. And of course, mainly it swivels all around this thing known as the US dollar. Be very, very interested to see how Orlando thinks, or what he thinks about the US dollar as we get into our show. But before we do that, a lot of these things, of course, are based around fundamentals. And I'm wondering what Lexi is making of it all. Are we turning around, Lexi, or are we expecting more of the same? Is this just a little covering rally or not?
Hi, Jeff. Yes, I think one of the things I'm going to be talking about today is the US dollar. I mean, it is the current big topic that we are seeing around the globe. So hopefully, I'm going to flash you guys a couple of information, and let's see whether we can work our way around the US dollar question.
It's a big one.
Yeah, it's a big one. Okay, I'm gonna share my screen, and I'm gonna share with you guys some charts and some pictures. So this is a CPI chart for the last the inflation chart for the last 150 years. All right. So these are the events that have been what we say causing inflation historically for the last 150 years. So we have the banking pandemics in the 1700s, in the 1870s to the 1930s. We have World War I, the Spanish flu, World War II, Great Inflation 1975, the dot-com bubble year 2000, and of course now currently we have the COVID plus post-COVID pandemic 2021-2020. So I think if they add on to this chart in 2022, they have to add the Russian-Ukraine conflict as well. So a couple of things. I think the question is: is the US in a recession? And what happens then? So for those of you who are probably a little bit new to economic definitions, I'm just going to do a very simple. Guys, go Google definition of recession. So I think the main basic definition is that it's a recession just means there's low economic activity. And by economic activity, it means basically you don't have jobs, hence with insufficient jobs, there will be low economic activity. All right. So it doesn't quite mean that the GDP shrinking is a low economic activity. And bearing in mind, the GDP is a lagging indicator, right? So the GDP figures are lagging, but the unemployment figures are released a lot faster. And the unemployment figures, if we look at trading economics, doesn't show that economic activity is lagging. So if you look at the jobless rate for the US for the past couple of releases, right, from January to April all the way, you can see that employment is actually increasing. So where is the inflation coming from? Where is the recession talk coming from? It's actually a combination. So after the pandemic, right, or during the pandemic, we had a supply chain problem, right? The ports were getting jammed. The cost of shipping, I think, went up 4 times. So if you were shipping, and I think if you were trading with any other country, you realize that the ports are delayed, shipping is more expensive, shipping has gone up 3 to 4 times depending on where you live. So we had this supply chain problem. And of course, if you think about it, if it's going to cost 3 to 4 times more to ship the goods into whichever country you are, what are the corporates going to do? The corporates are going to pass on the pricing to the consumers, right? So this is where we find that, okay, our regular goods that we usually buy are now more expensive. So during COVID, it was a supply chain problem. Whether or not it's fixed right now, I think supply chains has improved, but it is still facing a expensive shipping issue, because China is still in lockdown, right? China is the major exporter of the world. We have the Russia-Ukraine war happening, so shipping lanes are disrupted over there. And then, of course, we add the Russian-Ukraine conflict, which causes the price of oil to be a big question mark. And when I say question mark, I would like to just share with you guys the trading view chart of the oil prices, and just to see where we are pre-war and post-war, right? So if you look at the trading view charts, I think it's really going to be really interesting. And what I've done over here, all right, Basically, if you Google when did the Russian-Ukraine war start, the official date that came out was 24 February 2022. So if we put our marker over here, you can see 24 February. I'm just going to put a vertical line on this 24 February it's over here, right? This blue line over here. So basically, the moment Russia invaded Ukraine, right, the price of oil became a question mark. Why? Because, Russia is a supplier of oil, US is a supplier of oil, and then there's this whole talk about, is there enough supply? Is there not enough supply? And then we have Russia selling to India regardless, Russia providing to China regardless. So the actual supply and demand of oil becomes a question mark, because what's happening behind the scenes as retail traders, we don't quite know. We only know what the newspapers are coming out, right? And one week they will say, Russia is actually supplying oil to India at a cheaper rate. The next week they say, okay, there are sanctions on Russian oil. So price became, you can look at the candle, just look at the candlesticks pre-war to post-war, right? The post-war candle, or I would say when war started, the candles become very big, very unpredictable. There's basically a lot of question marks happening in the oil side. But as corporates, right, so shipping is expensive, oil is expensive. So it's going to be more expensive to fuel the ships to come in to wherever you are. And that, of course, where does the price go? It passes on again to the consumer. So it's like a double whammy there. We have the shipping cost, and then we have the oil cost. Even petrol costs us more now, when we pump our petrol in our cars, our tanks, right? But unfortunately, we are not going to stop pumping petrol. The demand is still there. And if the demand is still there and the supply becomes a question mark, what happens? It's a pure demand and supply issue. Prices go up. So inflation continues going up. So what the Fed is trying to do now, the Fed is trying to push down inflation by doing what? By increasing interest rates. But the problem now is, can high interest rates actually stop inflation? All right, and this is where it gets even more murky, because you have high interest rates, which means cost of borrowing is going to be higher, cost of investment is going to be higher, right? If you're going to borrow money to buy a house, buy a car, it's going to increase, right? So what's going to happen again? We are going to pass all these costs back to the consumer again, exacerbating inflation. Interest rates increase is supposed to deter spending. All right, but due to the pent-up demand, the 3 years of saving money, not traveling, nowhere to spend the money, those money is still floating around. The trillions of stimulus checks that the government has given the people, they can't spend it on holidays and stuff like that. So those money still floating around. Now when markets are finally opening up, you have your airfares coming back, your tours coming back. So there is still a demand for spending. All right. So all this is pushing inflation yet higher. And this is one of the reasons why inflation is higher. So what are the ways to fix inflation? I think the very first thing is we have to figure out whether or not Ukraine and Russia stop fighting, where there's a bit of clarity on the oil cost, because the oil cost, I think it's incepted in a lot of production costs in a lot of goods and services. All right. So until there's more clarity over on the Russian and Ukraine side, we are going to see continued high inflation. It's not going to be fixed within a couple of months. Hopefully it's fixed faster, but it doesn't look like the statistics support that issue. And then on the other hand, let's talk about the US dollar. I'm going to show you another article. Now, I think a couple of weeks ago, I spoke about bonds, right? And how I think the bond market is going to get a lot of attention. And then this article was 16 hours ago, so it just came out yesterday. Emerging markets hit by a record streak of withdrawals by foreign investors. So exactly what I was talking about. The emerging markets are countries like, Chile, China, Colombia, Malaysia, Mexico, Philippines, Poland, Russia, Saudi Arabia. So money is coming out of those emerging markets, but where is it going to? Right? Where is it going to? And if we look at the interest rates, of the US right now. US is having a 2.5% interest rate. Okay, 2.5% interest rate, which means it implies the bond yields, the attractiveness of its mid to long-term bonds are there, right? If you are pulling your money out of emerging markets for this fear of recession, where are you going to park it? Right, the next safest parking place would be in the countries with a slightly higher interest rate, like, for example, the US. And so what's going to happen to the US dollar? I suspect the US dollar is going to find renewed strength after people realize that, there's nowhere else to park their money except these couple of countries with a higher